Hey everyone, in this video I wanted to bring you one beaten down growth stock that I think you might regret not buying on this dip here. The stock is down 82.6% and I think it's a good value. I'm going to share with you what this growth stock is, but before I do that, I'm going to highlight some of its financial metrics so you can see what has me attracted to the stock and why I think it's a good value now that it's discounted so significantly. So let's get right into it. Starting with revenue over a trailing 12-month period, look at the revenue growth this company has demonstrated. And another thing I will highlight is look at the huge dip in 2020. So you could see this company was one that was devastated by the pandemic because revenue collapsed from over 5 billion in the trailing 12-month period down to close to 3.5 billion. So it is an in-person business, and um, that's all I'm going to share with you about the business. I don't want to give away too many details because I don't want to reveal the stock too early. I want you to look at the financial characteristics of the business first before you make any judgments because of the name of the company. So, if you look at the 6.5 billion in trailing 12-month revenue, you can see it's way ahead of where it was before the pandemic crashed its revenues. So the company has rebounded stronger than before the outbreak. And I suspect these strong revenues will continue over several quarters more because consumers are absolutely unleashing this pent up demand for away from home experiences, for doing things outside of the house. And that's understandable, right? We were stuck at home for 2 or more years, depending on what part of the world you're from. Tired of being at home. People want to get out. People want to spend their money on things outside. We've bought enough goods for inside of the house, right? So this company stands to benefit from the continuation of that trend. Additionally, the company does a good job of generating cash flow from operations from the sales that it generates. So it generates sales and those sales turn into cash flow. That's one of the hallmarks of a business that I look for is turning sales into cash flow. I'm not so attracted to businesses that generate excellent sales growth, but then when you look at its cash flows, they're negative and going in the wrong direction. That's not very attractive to me. I would prefer that business spend time putting itself on a better foundation so that when it generates growth, that growth leads to positive profitability and cash flow. This company does a solid job of that. A 12.3% cash flow from operations to sales is not one of the best among the companies that I follow. Although in the type of business that it's in, it's a brick and mortar business. It's a capital intensive business, which are businesses that I'm not usually attracted to, but I'm making an exception for this one because I like the type of assets that it has, and I'll talk more about those assets at the end of the video after I reveal what company it is. So, considering the type of assets it has, I think a cash flow from operations to sales of 12% is solid. In the double digits is solid, and considering it's got good growth prospects for the next several quarters, I think it can raise this further still. And finally, the stock is relatively inexpensive, trading at a forward price to earnings of 14.4. So it's growing revenue. It's better than before the outbreak. It's got excellent prospects. It's riding that tailwind of consumers unleashing pent up demand for away from home experience. And it's trading at a relatively inexpensive valuation. So, for all those reasons, I think you might regret not buying this stock. What's the name of the stock? It is Penn Entertainment, formerly known as Penn National Gaming. It's a casino stock, it's a gaming stock. I know some of you might have some reservations about investing in gaming stocks, and I totally understand. But to talk more about what I talked about its assets, this gaming company has casinos, brick and mortar casinos, in areas outside of Las Vegas. And these are areas that I think are recovering, and you could see that they're recovering stronger than Las Vegas is because it doesn't have the exposure to convention center business. Business travel is still down significantly from the levels before the pandemic, and it may never get back there. And so I like that this casino stock does not have exposure to the convention center business the way that some Las Vegas casinos do. So for all those reasons, I think you might regret not buying Penn Entertainment stock on this dip here. All right, but that's all I've got for this video. Thank you so much for watching. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.